Hello and welcome to this FundForum webinar. I'm Clare Flynn Levy, founder and CEO of Essentia Analytics, and I'm joined on the line with Richard Balarkas from Compliance Solutions Strategies and Catherine Doherty, who is Managing Director of Investment Management Business Insights at Accenture. So welcome. We will be live tweeting this webinar, so you can join in on the conversation using the hashtag FFWebinar. Now that it's live, MiFID II is making headlines in the world press, framed as a punishment for past misdemeanors and the catalyst for a new Big Brother-style regime in the asset management industry. But to data analytics fans, MiFID II is also a massive opportunity. Starting in Europe, but inevitably spreading to global firms located in other jurisdictions, asset managers are being forced to collect more detailed data about their past investment decisions that, if used proactively, can be utilized to make measurably better ones in the future. But to what extent are investment managers actually thinking this way and taking advantage of the opportunity? That's what we're going to discuss today. But before we do that, I'd like to remind you that we will be holding an interactive Q&A on this webinar. If you have any questions during the presentation, you can send them to us using the Ask a Question button on the bottom of your screen, and we will address questions after each of our speakers has said their piece. So again, if you click on the button that says Ask a Question at the bottom of your screen, you can tell us what you're thinking, and we will do our best to answer it. So first, we're going to hear from Richard Balarkas, who's going to quickly introduce himself and give us a little background on his perspective.
Thank you, Claire. Let me kick off with a little background about myself. So I've been in the markets about 30 years, and I've worked for various organizations, head of national market development at the London Stock Exchange back at the time of Big Bang, global COO for trading at BZW, global head of electronic trading at Credit Suisse, CEO and president of Internet Europe, and I'm currently on the board of SIBO Europe as an independent non-executive director, and on the board of Saxo Capital Markets UK. I'm also an advisor to Compliance Solutions Strategies, which is a global regtech firm focusing on buy-side needs. I just want to make the point at the start that despite the tone of the paper that hopefully you've all seen and Claire's introduction, I don't hold myself out as an apologist for regulators. I think it's fair to say that in my career I've often been, well, I usually am very supportive of their intentions. I'm not always a great fan of how they put regulation into practice and how they go about achieving it. But nevertheless, it's something we've all got to live with. It's been a feature of my career for 30 years. It's going to be a feature of the markets and businesses going forward as well. I don't see it ending. But every time there's been significant regulatory change, it's usually been accompanied by a shift in the usage of technology. Technology has been a huge enabler to the kinds of changes we've seen in the markets and the way that markets have been made more efficient. And it's also been associated with competition. Now, there's a bit of an uncomfortable marriage between regulation and competition. Sometimes it's hot, sometimes it's cold, but I think on the whole, if we look back, we can see that regulatory initiatives have been very much tied with trying to introduce and create an optimal environment for competition within firms. I think it started very much with stock exchanges. It's extended out to banks and the sell side, and I think the crosshairs of regulators and the focus is very much on the buy side at the moment. Now, the theme of what I wrote, and I wrote this almost a year ago now, but it's pretty clear to me that coming out of MiFID I and MiFID II especially, the direction of travel of regulation is absolutely clear. There's still, I think, a lot of unfinished business as far as the regulators are concerned in terms of ensuring that the industry as a whole, the value chain front to back, and especially at this point in time, the fund management industry, can demonstrate that there is an alignment of interests between themselves and their clients. And they're achieving this by writing more and more rules and by insisting upon more and more transparency, all the way through from the definition of products. And the definition of products just doesn't include package funds, it includes things like ETFs, through the KYC process and understanding your clients' needs and ensuring that not just when you sign those clients up to those products, you're marketing to the right client groups, and that on an ongoing basis, the investment decisions you're taking are still in alignment with your clients' best interests. And transparency is the way that they want the industry to demonstrate it, to demonstrate this, and the way to do that is to capture enormous amounts of data. Question may well be asked about what the regulators do with it. That's neither here nor there, but the simple fact is firms are being asked to capture all manner of data, including, for example, telephone conversations relating to individual trades, telephone conversations relating to trades that are not undertaking, why you didn't invest. Now, this all reminds me a little bit of the MiFID I experience, where brokers were told to get their act together when it came to best execution, to write execution policies so that clients could see how they traded, where they traded, what kind of tools they used, what factors they took into consideration, and to make these execution policies public and available to all their clients in the hope that this would, again, stir competition. The clients would be more discernible users of brokers' execution services. You know, competition would be enhanced. Now, the experience at the time was that, I for one thought, great, let's actually put down in huge detail what we do and how good we are and explain it and justify it to our clients. The vast majority of firms did as little as they possibly could. They handed this over to their lawyers. They collaborated. They came back with one side of paper that absolutely meant nothing. So execution policies turned out to be a bit of a washout. They didn't stimulate competition. But 10 years on, firms are now opening the doors. They're being very transparent about what's going on. That part of the industry, that part of the value chain is now measuring performance down to tenths of a basis point. It's measuring speeds in nanoseconds. It's not just measuring simple implementation shortfall. They're looking at the toxicity of the different liquidity pools that they are going to. And it strikes me that this could well be a parallel for MiFID II and the data capture that is being asked of fund managers. There's a clear parallel here. Now, firms could well adopt a view of simply wanting to capture as little as possible. On the other hand, why don't they see it as a competitive advantage to start to capture information pertinent to the decisions that they're making, information that will help them when it comes to marketing to their clients, help them demonstrate their USP, help them differentiate? Because, if there's one thing we read about all the time, it's how difficult it is at the moment, especially for active investors, to demonstrate the value that they add to a portfolio. There's a bit of a chicken and egg situation here, I suppose. The financial service industry can be criticized for being not very good at marketing and selling. Is that a cause or an effect? I think it's probably an effect of the fact that competition has not been as hot as it should have been for years now. And I don't also buy the argument that, look, at the end of the day, we don't need to disclose all this stuff because it's all in the price. I just don't feel that anyone who adopts that view has got a sensible and relevant marketing strategy. So is the cost of your building, so is the cost of the computers you buy, or whether you get cheap rent. That all presumably is in the price as well. That's not going to help you differentiate when it comes to marketing. So I'll wrap up there. I just feel that if you have to go out and capture all this data, you might as well do it with a positive attitude, with gusto, and use it and capture the kind of behavioral finance type information, triggers, tools, and nudges that you may be adopting in order to demonstrate to your clients why you have the edge. I'll stop there, Claire.
Great, thank you, Richard. So now we're going to hear from Catherine about what she's seeing in her practice on the ground. Catherine.
All right, thank you very much. And to do the introduction, I've been working for the last 20 years for a firm called Investit. A lot of people will know about us. We're a specialist management consultancy. We only consult to investment managers. But last year we joined Accenture last September to bring really their wider technology competencies to the investment industry, because we just felt that the technology world was moving on too fast. We needed access to that wider range of skills. I do need to give a big health warning that the views in this conversation are my own views, they're not Accenture's views, and they especially do not represent Accenture clients, because most of them have finished or got nearly to the end of their MiFID projects by the time I joined. So MiFID 2 and its infamous 65 fields. Just to put it in context, you may remember 2015, 2016, everybody was going through the usual stages of what you might call the regulatory grief process, which is now routine, of denial, anger, bargaining, depression and acceptance, where it takes you a long time to actually get on board with a piece of regulation and start to think how it could work for you rather than just pushing back. And with MiFID 2, we also had that thing that it got moved back by a year. So just when everyone was asking for more time, they were given for more time. And instead of saying, wow, this will really give us a chance to sort things out, a lot of firms said, excellent, that gives us a year to get other stuff done and then we'll come back to this, which I did think and do think was often an opportunity missed. I will say, though, that when I'm thinking now about firms and looking at how the MiFID projects went, there are three very different constituencies from MiFID 2 projects. The first one is the bank-owned firms, where we already see these massive fines coming out from the regulators for all sorts of different things. And so their focus on regulation has been very different. Their commitment to regulatory projects has been very different. And generally, those firms have put a lot of resources into these projects. At the other end, you've got little firms, and little firms find this sort of stuff fairly easy because the data is already in one place and it's relatively straightforward to join it up and send off to regulators. And then you've got the bunch of firms in the middle, and they're the firms who could have benefited really from MiFID 2. And one of the things that MiFID 2 could have given them is that focus on internal data governance, which you need in order to be able to get all the data to join up, in order to be able to report for any of these regulatory requirements as easily as possible. And I think that's possibly the area where this was a missed opportunity, that firms got the reporting done, but they didn't do the work behind the scenes to get the information joined up. And so, yes, now you've got a mineable set of data, but what you probably haven't got is all that quality of maintenance that's really going to make this data accessible and insightful. I will also say that so you've now got fields which hopefully show you who's involved in the trade, what was involved in the trade, what the market context was across more instruments. Data is only as good as the information you put in, and if you don't put in things like a reason for trade in a coherent way, it's going to be quite difficult to work out what's going on. Although, and I think we'll come on to this, there are now some very interesting new tools to do it. One point I will make, though, is as firms do seek to differentiate themselves, hopefully by engaging more with their investors and by showing them what's going on, if you are a buy and hold investor, you may struggle to get the story out of your trading information, because the trading information will really highlight over trading rather than under trading. So there is more of a picture that you're going to have to join up, but then hopefully your data governance program will also have helped you start that journey towards that data as well. Over to you, Claire.
Great, thanks, Catherine. Just a reminder to everyone who's listening, if you haven't already done so, I encourage you to submit questions via the Ask a Question box at the bottom of the screen. So for my sins, my background is as a fund manager. I was a tech fund manager at Morgan Grenfell Asset Management back in the late 90s, and then I ran a hedge fund in the early 2000s, and always focused on tech, and have since moved over and sort of gone native into running tech companies, and most recently starting a company called Essentia Analytics, whose sole purpose is to help professional investors make measurably better decisions. Now, the way we do that is all about data, and that's why this topic is of interest to me. I'm coming at it from the front office's perspective and saying, the purpose of a fund manager is to make decisions all day, every day. Some of them are explicit decisions, some of them are implicit decisions, but it's all about decision making. So if you want to be good at it, and obviously the pressure to be good at it is greater than it's ever been before, given the cheap alternatives that passive vehicles offer. If you want to be good at it, then you really need to have a feedback loop on your investment process. Historically, fund managers have outlined their investment process in PowerPoint and then measured the skill or the strength of value add from that process through performance. And yet, performance is a measure of outcome. It's not a measure of skill. It's hopefully a function of skill to some extent, although some people would argue that it's all luck. Every fund manager out there would agree that there is a large proportion of returns that are attributable to luck. And so if you're trying to do the job, the question is, how much of this is skill, and which parts of what I'm doing day to day are actually adding value or destroying value? And how can I do more of what I'm good at and less of what I'm not good at? Well, to me, that was, a fundamental gap in my ability to do my job. Not having the data that fed back to me, here is how you should be spending your energy, do more of this and do less of that, was just ridiculous as far as I could tell. If nothing else, I had trade data and holdings data. That's a baseline data set that has a time series to it, and we know what the price of each one of the instruments that I was trading was over time. So why couldn't we measure which types of decisions was I good at and less good at? Now, back then, there were a number of reasons why that wasn't straightforward to do, but now that's changed. Now that is very doable if you know what you're doing. And the bigger question, once you've identified whether a fund manager is adding value through, picking decisions versus entry timing decisions versus sizing decisions and so on and so forth, the question then is, in what circumstances do I make my best decisions? And to the extent that you're capturing data about why you're doing what you're doing, there is very low-hanging fruit there when it comes to alpha generation. Way easier to exploit than buying alternative data sets about other people's behavior. Those are easier to buy and easier to stomach, but you can't control other people's behavior. You can control your own behavior. And that is why this concept of a data-driven feedback loop is intriguing to me. Now, to the extent that MiFID is about transparency and transparency with one's end investors, we, I think, in the investment management industry, should all be thinking about how it enables us to be transparent with ourselves. That's not something that necessarily comes naturally to everyone, but it's very important if you want to continuously improve as an individual and as an organization. And what we're finding is that, driven by the front office, more and more firms are waking up to this concept that they're sitting on a mine of very useful data about their own behavior, that if they could analyze it, would help guide how they should be deploying their energy and their capital going forward. And some of the firms that we're working with on that are, you know, very old school and very long-term and low turnover, and you know, they're looking for a baseline set of independent proof of where the strengths and weaknesses of their PMs and their teams lie, not so that they can fire them, but so that they can help the PM actually improve. You know, these PMs are smart and they get paid a lot of money, and it's in everybody's interest that they improve. But what the next gen PMs are doing that I'm seeing less of in the sort of old guard, although I hope that that changes, is capturing more data about the process itself. So if I just show you a little slide here, when I talk about a data-driven feedback loop, what I'm saying is if you give a system like ours data about all your past decisions, and it could be analyst recommendations, but if nothing else, trades that have been done, we can analyze it, and we can come in and sit down with you and talk about what's working, what's not working, in what market contexts are you making your best and worst decisions, and is there, you know, actionable insights that can come out of it. And then we can use technology to nudge you when we see you committing a behavioral pattern that you've said you want to avoid. And that means that on an ex-ante basis, you can start to mitigate your own behavioral biases. And that's very effective, and it really leaves the power in the hands of the PM, which is useful. That's just using trade and holdings data. But what the next gen PMs are increasingly doing is saying, we want to capture more information about the why, because we want to codify the investment process. And that goes, you know, at a bare minimum, that's a trade reason. And it could be, you know, a standard set of drop downs that they're selecting from. Or it could be a lot more detail about what was the source of the research we used, or, you know, what was the primary research that we used? Who's the owner of this position? What kind of trade was this? What did we think the target price was, or the target return was when we went in? How big do we expect to be in the position? There are lots of things that any good fund manager has in their mind when they enter a position, or when they add or trim or exit, that are being recorded in prose probably, but not so much in standard or structured data. And so part of what we do at Essentia is nudge them to capture that data and make it a sort of push experience for a busy fund manager who doesn't have time to log into something and you know, write chapter and verse. And that means that the richness of the data that they're capturing about every single decision is that much greater, and it means that the insights that they can get out and the nudges that we can then send them to help them mitigate their own biases are that much more valuable. So the moral of the story is that if MiFID is about transparency, and if you're collecting data, even the bare minimum of data for MiFID purposes, it is worth considering being transparent with yourselves as individual fund managers or as a firm. And it is worth considering going even further and capturing data that the regulator's not yet asking for, but that will help you do a better job. So that's all I had to say. Again, if you have questions, please do click the button that says to ask your question now. And I think we do have a few questions. So let's see. The first one is about examples of what an investment manager can provide to clients from its new MiFID II data sets that will provide a competitive edge. I mean, for my part, I would say that is even capturing some contextual data about what was going on in the market at the time, and that might just be about snapping the behavior of the price in the surrounding time, which you might be doing for best execution anyway. But moreover, capturing the reason. If you can capture a trade reason and a name of a person and a time of day when the order was placed, that is already interesting information for feedback. But Richard or Catherine, do you have a view on that?
I'd endorse what you just said, but I'd go further and say, when you think about sales and marketing, and especially about using this data, you're not taking a snapshot. You're not going and laying a best execution policy on a client's desk and say, here, read that, and then go away and leave them with it, let them interpret it themselves. Similarly, you don't send them a piece of data about why you traded. One of the advantages of having this data is to be able to demonstrate to clients that you have a process and that you have a process that is continuously improving. And I've never, touch wood, I don't do too much anymore, but in the past, when I used to go to clients with numbers that they'd never seen before, some of them looked horrendous to me, and I used to be quaking in the taxi on the way to the meeting. But I never actually met a client who did not appreciate getting more information, more data about what you do and how you do it. And when I appreciate it, I mean, they have a more solid bond with you, they give you more business as a result, and you both work together on improving the process. And reflecting on what Claire said there, you can start to use some of these behavioral tools like those from Essentia. You can go to the client with, typically I would expect to be able to go to a client and show them how over time the number of signals that you're getting has changed, how you're responding to those signals has changed, how performance has changed as a result of all that. None of this is going to be specified in rules and regulations. It's creative sales and marketing based on data that you can capture today.
Yeah, exactly. I mean, we definitely see sales and marketing teams using the output of the work we're doing with PMs in their discussions with their clients, and the clients love it because it not only tells a story of what you were actually thinking when you bought this, with a visual record of that, but it shows that you are actually trying your very hardest on the part of the client. And although that might be, assumed, the industry's had a bad rap recently, and it goes a long way if you can reassure people. But so Richard, I know there was another question about whether prospective clients will be likely to read every page of a 25-page best execution policy. Are you saying not necessarily, but it's reassuring to have it there?
Well, what I'd say is, again, this is an example of where, you've got to decide whether you're in a business which is a compliance business with investment management as an offshoot, or whether you're in an investment management business that just happens to have compliance as part of the culture. Because if what you do is go out with a regulatory defined piece of paper like a best execution policy and expect that to work as a piece of marketing literature, it's just not going to happen. But what you can do is you can embrace what the regulators are trying to get you to do with the best execution policy. And you know what? People hate the idea, but you can gold plate this. You can turn it into a piece of marketing material. You can put in there bits of information that you want to emphasize, bits of information that you believe are important to the decision making of your clients, and use it positively. So no, I'd never expect a client to read a 25-page best execution policy, but I would want to hit them with all the salient facts and represent my firm and make sure that they understand that our interests are aligned. So there's a big difference between ticking the box when it comes to filling in bits of paper to keep the regulators happy. And using that information in a completely different way to demonstrate to your clients that you are acting in their interests and you've got this continuous process of improvement for both sides.
And so if I can jump in there as well. So the essence of good client reporting is that you remind the client what it was they bought, you show them you did it, and you show them that it worked. And showing them you did it is part of what you can do with this. So you can say, in conditions like this, we said we would trade like this, we have traded like this, here it is happening. You can also show them that you are an evolving organisation, which it said, you know, we've noticed these trends in the market, this is how we're adjusting our behaviour. So those are things where you can make the product more interesting to a potential client and more trustworthy. The other side of it is going to be very much over the next few years that it will give you information about where you're wasting money internally. The firms are going to come under intense pressure on costs because as margins go down, it's all right having 34% cost-income ratio, but you don't need a big squeeze on fees to get rid of that. So there will be this big focus on where is my value really coming from in the front office, and we're seeing a lot of work being done, and our AI teams are being asked about this a lot. Can you join up all this information and show me where the value is actually coming from? And these sorts of information stores that now people have had to create will just be gold dust at that point.
I mean, it's very exciting if you choose to look at it that way, to get this kind of clarity if you run an asset management business, or indeed if you intend to, you know, compete in the asset management business going forward. But it's different to how things have been done historically. So that is something that we all need to wrap our heads around. Now, that's all we have time for, I'm afraid. I want to thank everybody for joining us today. And if you have any feedback on today's webinar or any recommendations for future webinars, please do complete our short survey at the end of this webinar. It should flash up on your screen shortly. And you will also shortly receive an email with a recording of this webinar and an exclusive 10% off discount for FundForum International, which is taking place on the 11th to the 13th of June in Berlin. So I hope to see you all there. And with that, I will thank Richard and Catherine for joining me on this webinar. I hope you found it useful. And we will say goodbye. Thanks very much.
Goodbye.
Bye.